You've got a forward PE under 7. You've got a dividend yield over 4%. You've got a stock down 22% year to date. And you've got the company telling you in their own financial documents that the tangible book value per share is over $80 per share, and the book value per share is nearly $93. Why in the heck is Citigroup, even after reporting absolutely stellar earnings today and up over 10.5%, a $48 stock? We'll talk about that and more on today's show. What is going on, investors? Hopefully you guys are doing well out there, and I can imagine there's quite a few of you that are doing well because I got a ton of requests on our channel today to cover Citigroup earnings, which came out before the bell. I can imagine some of you are holding this stock and seeing this thing rocket up today over 10.5%. That's on the heels of these Q2 earnings that came out that are incredibly impressive. Revenue for Citigroup in the most recent quarter came in at $19.64 billion. I'll walk you through all the numbers. We'll take a look at the revenues. We'll take a look at how they're managing their expenses year over year, quarter over quarter. This company is profitable as well. We'll talk about the profits. We'll talk a little bit about banking regulation, which quite frankly gets pretty complicated, but we'll go through all of those things when it comes to Citigroup. $19.6 billion worth of revenue. Folks, that was 12.4% year over year growth rate. No, this is not Facebook. This is Citigroup growing at 12% year over year on a quarterly basis. They beat expectations by $1.3 billion. This is with a lot of headwinds heading into Russia. This company actually has quite a large business in Russia. Among the other headwinds we're seeing in the economy, they did a fantastic job because when we come over here to revenue estimates over at Citigroup, we see in the most recent quarter, they were supposed to come in at $18.3 billion, grow just 4.7%. And I just showed you they grew 12.4%, beating expectations by over $1.3 billion. You see in the upcoming quarter, look, analysts aren't giving them much credit. They're expecting revenues to actually drop down to $18 billion and then follow that with another drop under $18 billion. Wall Street is predicting that this acts like a lot of financial institutions and grows kind of mid to low single digits in the foreseeable future. But Citigroup absolutely bucked that trend, but some of the news is a little negative when it comes to Citibank. But I think as we can see the price action of today's stock rising 10%, a lot of that bad news was probably priced in and maybe a little overpriced in. Okay, they paused their stock buyback. They're not going to raise the dividend, which currently has a yield, I would guess, after today's climb in share price, still over 4%. You're getting over $2 per share over at Citigroup. Some of this bad news was priced in a little bit, and then we'll talk about this from a technical perspective. This is one of the most interesting stocks I've ever looked at from a technical perspective. I think it's clear as day what you do if you own Citigroup shares or if you plan on buying them anytime in the near future. I think it's very clear setup. We'll talk about that more in a moment. But Citigroup, a lot like Bank of America, a lot like JP Morgan, deciding to pause their stock buybacks, deciding also to pause their dividend as they have to raise their common equity tier 1 capital by several percentage points in the coming months and weeks ahead. They're looking to target at a 13% clip. Currently, they're sitting at about 11 to 12%, and 1%, 2% doesn't sound like a lot, but you're talking about tens of billions of dollars when this company has to raise these capital ratios. And I'll be honest with you, I did a lot of research last night on this because I knew it would come up in today's video. It's very complicated. You have Basel III, Basel II, Basel a million type of regulations on these banks, and I'll show you that this company has incredible leverage in its system, meaning they have borrowed a boatload. I mean, we're talking about a mountain of money to leverage up this balance sheet, and we'll certainly reference that when we talk about this company's valuation. Speaking of that valuation, there's a lot of investors that are going to say, look, Citigroup trades at a fraction of its tangible book value. I showed you at the lead off of the show the fact that this company in its own financial statements is telling you that the tangible book value per share, which is essentially if we were to liquidate Citigroup's all their assets, all their book of business, we were just to liquidate it maybe on eBay or Amazon, we would be expected to get close to $80 per share for those assets. And at the current time, even after a 10% rise in the share price, Citigroup is currently trading at 0.55 times tangible book, or a fraction of the tangible book. And some people might make the argument that that is one reason to buy Citigroup. I wouldn't argue with that reasoning, but one thing that we have to remind ourselves with Citigroup is when we pull up a 10-year price to tangible book over at Citigroup, it is actually the norm that Citigroup trades underneath its price to tangible book. In fact, over the last 10 years, it's spent just a handful of months, or probably more accurately, just a handful of years over 1 times tangible book. In fact, the vast majority of the time it trades underneath its tangible book value. I'll show you why here in a second. But when we pull up this 10-year price to tangible book, you see we are close to about a 0.5. I mean, basically a 50% discount to the book of business that Citigroup owns. When Citigroup reaches that level at 0.5 tangible book, it does signal some buyers stepping in. And some of you might be wondering, why does this bank trade at such a discount to its tangible book value? Also, when you look at its peers, if you were to bring up a JP Morgan, certainly a Bank of America, even a Wells Fargo, doesn't trade at this deep of a discount to their book of the business. One of the reasons, and probably one of the primary reasons, is when you pull up the balance sheet over at Citigroup, we have our long-term debt down here, and you have to scroll all the way to the right-hand column to get our most recent quarter. And this number is not 257,000. This is not 257 million. This is 257 billion with a BBB, $257 billion worth of debt. Now, it is down 3% year over year on a quarterly basis. We are up just fractionally quarter over quarter from 253 up to 257. So that is one of the reasons why when you look at like an AT&T, when you look at a Citigroup, you've got a mountain of debt. So when you have a rising interest rate environment, in some cases, we see with Citigroup's stock chart, this stock has been basically in free fall since June and July of last year. Certainly when the Federal Reserve started to telegraph they were going to start raising interest rates, this stock took an even larger leg down. One of the reasons why is this company relies on a lot of leverage, and that leverage can cost you lots of money as you see interest rates start to tick up. Now, as a bank, they can earn that money back, but as we talked about at the top, there's so much banking regulation out there right now, and it's one of the reasons why this sector, in my opinion, will always take kind of a back seat, especially if you're in a growth mode in your portfolio, if you're trying to grow your wealth, if you're trying to, beat the S&P 500 or at least keep up with it. One of the reasons why financial stocks tend to go to the back of the bus on those types of things is the fact that there's so much regulation, and as you start seeing interest rates start to tick up, as you see the risk of a recession coming on, a company with this amount of debt actually has to start playing defense rather than offense, as evidence of them pausing their buybacks, pausing dividend raises, and having to raise their tier 1 capital, essentially increase their cash position, decrease the amount of leverage that this company carries. Now, from an let's ignore the fact that this company has a pile of debt that is almost unrivaled in the stock market and, quite frankly, the world. Let's ignore that fact and just look at these quarterly financial results, because I will also show you from a technical perspective, this is a thing of beauty as well. But also, from a thing of beauty are these financial results. The fact that they produce results up 12.4% year over year. Look, Facebook will report in 2 weeks. I can almost guarantee you that company will not grow 12.4% year over year. So Citigroup is actually growing faster than some of the high-flying tech stocks out there. And we'll see here, total revenues, $19.6 billion. That was up 2% quarter over quarter from 19.2 up to this 19.6. Year over year, you're up 11%, 17.7 up to this 19.6. I think even more impressive than that is the fact that we're seeing this company actually do a nice job controlling their operating expenses. We didn't necessarily see this with JP Morgan. In fact, JP Morgan kind of telegraphed that to a certain degree. The fact that it's going to be a big year of investment for JP Morgan. I don't think there was a lot of investors expecting them to kind of shrink their operating expenses less than where their revenue growth was. But we're actually seeing over at Citigroup, look, quarter over quarter, we actually decreased our operating expenses expenses. So we grew, and again, this is quarter over quarter, first quarter of this year to second quarter of this year. The most recent results are this far left column. We grew our revenues 2%, but we actually dropped our operating expenses by about 6%. Now, for the full year on a quarterly basis, doesn't paint as great of a story, but it's still not bad, okay? You grew your revenues 11%, but your operating expenses up just 8% from 11.5 up to this 12.3, folks. That is fantastic. You have $19.6 billion worth of revenues, and you have about $12.4 billion worth of operating expenses. Now, that's not the full story, especially when we're talking about these banks. We have our net credit losses. We see that still in this environment where consumers and even businesses are no longer getting PPP loans and stimulus checks. Well, we took out a lot more credit losses this time last year. In fact, $1.3 billion. Those declined 36% down to $850. So what you're starting to see with these businesses and banks like Citigroup starting to set aside money, because look at this net ACL build. This is essentially like we talked about yesterday with JP Morgan. They're putting aside money, and I'm referring to Citigroup. Citigroup is putting aside money in this net ACL build. They're putting aside this money in kind of a rainy day fund, thinking, look, we might hit a recession here. Maybe we're in a recession now. Maybe it comes in Q4. Maybe it comes next year, Q1, Q2, Q3 of 2023. Well, we're going to start setting aside money now just in case people default on their credit cards and other types of loans that Citi provides for consumer and businesses. We are seeing that they're building that up by 375. Last year, they released $2.4 billion of money they previously set aside in previous quarters. If you recall, during the height of the pandemic, I'm talking about the months after March. We're talking about Q2, Q3 of that year. Banks were setting aside billions. We're talking about billions of dollars, thinking consumers were going to default on their loans, their car loans, their credit cards. Well, what happened was actually the opposite. They got showered with money and stimulus checks, and the banks were able to release this maybe about a year later back into their system. It really impacted them from a positive way in a financial situation. Now what we're seeing is back to the opposite. Banks are starting to feel like, hey, rainy days are coming. It's getting a little cloudy out there in the economy. So we're going to start setting aside money, but just $375 million, nothing really that egregious. So your total cost of credit in the most recent quarter ballooned to $1.2 billion. And I say balloon because a year ago, you actually got to release, you got a credit essentially of $1 billion. So when you flow down all the way to Citigroup's net income, you take this increasing revenues at 19.6. Our operating expenses increased a little bit by about 8% year over year, but it didn't increase as much as our revenue growth. But what increased the most was this cost of credit. So that's going to really hurt your net income. You see down 27% year over year from 16.2 billion down to this 4.5. So there's a little bit of push-pull here. There's some really nice things on this revenue growth side. They're doing a nice job controlling their operating expenses, but banking regulations and the fact that this company has so much leverage in this system. I mean, they have short-term debt here at 40 billion. They have other liabilities at 86 billion. This company has a ton of liabilities. They have to be a little bit more careful than maybe some other banks out there, and that's certainly going to impact their net income. Now, what is a headwind today could end up being a tailwind into the future. If you're one of these people that believes that the United States is not going to go in a recession, or if we are in one, or if we're going to go into one, it's not going to be that bad. And a year from now, 18 months from now, it'll all of a sudden look like Q2 of 2021, where these banks are going to be able to release this ACL build back into the system, and that's going to bolster up our net income. Quite frankly, that's a pretty decent argument to make, and one that I wouldn't discount at all. In fact, I would actually say that might be the probable outcome, quite frankly. We'll see what ends up happening in the economy, although there's plenty of investors that believe maybe we head into a very deep recession, and banks like Citigroup, which are leveraged up to the hilt, are going to have to raise their capital ratios up to levels that will really impact their net income into the future. So when you hear that this bank is going to have to raise their capital ratio, what that means is they're going to have to set aside more money. They're not going to be able to use as much leverage in the system. That's probably going to slow their revenue growth to a certain degree and maybe get us back into these expectations where analysts were seeing that this was just a low single digit type grower in the subsequent quarters. Now, from a technical perspective, this thing looks so beautiful. Now, there's some things that are not beautiful about this. The fact that this stock is a $48 stock, it was over $48 back in 2013. Certainly, if you had put $48 into an Amazon or an Apple or a Tesla or any of these stocks back in 13, you would be mega rich. The other thing to realize with Citigroup is this was a $48 stock back in 1993. Many of you, including myself, were still in grade school back in 1993, and this stock has not recovered from its great financial highs. Again, before major banking regulations came onto the books after this great financial crisis, banks like Citigroup were able to leverage up their balance sheet and use it almost as a bazooka to blow up their earnings, and that's exactly what Citigroup does. But now what we're seeing is post-great financial crisis, okay, this big drop where you went from over $500 per share. Can you believe that? Over $500 per share all the way down to 14. There might be some reverse splits in here that's kind of affecting this stock price, but this is the great financial crisis, and it's centered around banks like Citigroup, which were over leveraged. And quite frankly, now you see the result of regulation on the banking industry. The fact that this stock has been in such a tight range for over a decade is absolutely amazing. But what we do notice with this technical pattern is it's been very steady. In fact, you have areas of support right now where the stock is sitting right now. Even after a 9-10% rise in today's share price, it's still sitting at the bottom of the range. And over the last 10 years, in fact, more than 10 years, anytime Citigroup has been sitting at the bottom of the range, it has triggered a buying opportunity because this stock tends to bottom out here down at the bottom of the range and move to the top. I will remind you, we are on a monthly chart. That's why this looks a little stretched out, and we've consolidated so much price action in a small area. But this is how I personally would play a Citigroup. If you bought this stock down here at these levels, maybe even a little higher, maybe you're in this one for $60 per share, I would sell it as it moves to the top of this range, because look at this price target. This stock has been trading like clockwork for the last 10 years. I would not expect it to do anything different. And what would it take for Citigroup to go from this low 50 to bust out from this upper end, which quite frankly, this stock could get comfortably back up to $80, $90 per share and still be kind of in this technical pattern? What would it take to break out over and above that? I tell you what, it would have to take a loosening of regulation. And I just quite frankly don't think we'll see that here in the United States. Banks like this will always be required to increase their capital ratios as times start to get tough or as times are perceived to get tough. And so in my opinion, this is a stock that you trade. This is a stock that you take profits on. Yes, you are collecting a 4.6% dividend yield. They are using some of their money to buy back the stock. They've obviously paused that, but this is a company with over $257 billion. And while they are profitable and they do a nice job, it would take decades. I mean, we're talking about decades to whittle that debt down. And I just don't think the stock performance will be there to justify that. So in my opinion, if you want to buy Citigroup down at these levels, I tell you what, from a price to tangible book value, about 50% discount on the book of business is where this one has found some buyers. The financials look good enough from a revenue growth perspective, from a profit, from a cost control perspective. Very well run bank. You're getting paid this dividend to kind of hold this shares and watch them go up. I would watch this one go up. I would take profits over this $63 level. I don't think I'd push it all the way to the top of the range. Okay, I'd start taking profits or at least hit a trailing stop when it got about halfway up this range, which should take you back up to about $62, $63 per share. Look, from $50 per share up to $63 is a massive gain in this. I would take those profits and maybe rotate into another financial institution or another investment. That's just personally how I would play it. Would love to hear how you would in the comments below. This is a really interesting stock. There's a lot of things to really like about this one, but at the same time, the fact that this stock is at the same price that it was decades ago is somewhat of a red flag. And on top of that, you've got these banking regulations and these capital ratios that they have to maintain. They have absolutely no control over that. The Federal Reserve essentially passes this down onto them, and there could be more banking regulation down the pike depending on who's in charge in Washington. I don't like to play those games, and that's one of the reasons why this stock continues to trade at a massive discount to its book of business. I hope I covered this stock pretty well, give you a little bit of insight. I do like this stock. I've actually owned this in the past, but like I've said, I've taken profits on this one, and that would be my recommendation for Citigroup investors. Hopefully, you guys enjoyed today's video. I'll be back again soon with more. Good luck with your investments.